You too.
Ladies and gentlemen, that will bring us to our next presenter, who's been involved in the market since 1997 and is the founder of Technical Traders. He is internationally recognized technical analyst and trader who is the author of the book, Technical Trading Mastery: 7 Steps to Win with Logic. His mission is to help his clients boost their trading performance while reducing market exposure and portfolio volatility. Ladies and gentlemen, here to present how to grow your wealth on autopilot is Mr. Chris Vermeulen, the founder of TheTechnicalTraders.com. Welcome to Traders Corner, Chris.
Hey, thanks for having me, Rob. Can you hear me?
Loud and clear.
All right, let me just grab my screen here. Haven't used GoToWebinar in a while.
It's our preferred platform. I'm familiar with a couple of them, but you know it gets the job done best for us.
All right, can you see my screen there? Does it show the full slide there?
Double your retirement income on autopilot, and I am going to guess that that's somewhere in the Caribbean by the color of the sand in the water.
Yeah, it's pretty tropical. All right. All right, well, I'll jump right into it. Thanks for having me, Rob, and thank you, everybody, for sticking around. I am going to completely change gears from what Marina was focusing on. She was focusing on nailing the day trading strategy, learning, figuring it all out. Day trading is highly addicting. I have been there, done that, and I'm switching gears. I want to show you something that's the opposite end of the spectrum, something that is very passive, but extremely powerful. So somebody who has large amounts of money, who wants to protect it and grow it, I'm going to show you how to do that. And I'm going to show you how to do it pretty much twice as fast as the average buy and hold portfolio with a fraction of the drawdowns, and it can really amplify things. So I'm going to show you how to make more money with less risk on autopilot by trading differently or investing differently. What I do here is I only hold assets that are rising in value. It allows us to avoid bear markets and multi-year drawdowns or multiple years where no returns are made because the markets have been below the previous highs. And this strategy doubles the return of the buy and hold portfolio, which you're going to see as we unfold. And when you get into retirement, there is probably an angle you've never really realized that I call it wealth math. The investment math actually changes once you kind of get into retirement. So my strategy here, I do not believe in diversification. The whole peanut butter theory, spread your money out everywhere. That is what everyone does. That is the way to have status quo results and ride the roller coaster of the stock market. I don't believe in holding anything that is going down either. And I also believe cash is one of the best positions quite often, and we can still make money when we're in cash. So before I get going, let me just quickly cover the disclaimer, and then we'll move on to some exciting, hopefully very new angles of the markets you never really realized. So access to this webinar is for educational and informational purposes only. We provide educational services that are meant to teach you the risks and reward of trading and are not implying or guaranteeing any profits. Past results are not necessarily indicative of future performance, and trading securities and options involves risks, so do not trade with money that you cannot afford to lose, and consult a licensed broker or financial advisor before placing any trades to ensure it's suitable for your personal circumstances. All right, so let's go into the first set of questions here. Now, I think we all know what this is. This was the COVID crash. I've got three kind of core questions to kind of ask everyone, which is, how many of you lost money during the COVID crash? You ended up panicking and exiting positions, and then took you either a long time to get back into the market, or you never even got back into the market after that. That is what a lot of people suffered from. And also, how many of you made money during the drop and then also made money on the recovery back out? That is definitely a harder game to play, but if you did do that, kudos, because that is pretty incredible to be nimble enough to see a crash, protect yourself, and start to make money and manage that type of volatility. But the most important question here I want to really kind of ask is, how many of you actually did nothing with your investments? You locked up, you just left your money with your advisor, or you just left your long-term position sitting there and you rode this out. You made it through, we went through the drop, it recovered right back. if you were one of those who had your long-term retirement account or your accounts in general just kind of holding there, you didn't do anything, you just rode it out, then you've got some serious trouble around the corner. That was more or less dodging a bullet. And we're going to get into what could be happening going forward here. That's going to really open your eyes to the risks involved with the buy and hold strategy, the risk involved with not managing risk. It all comes down to risk management, which isn't the most exciting topic because people don't want to take losses. They don't want to get out of assets, but the reality is we have to do that. So let's go over quickly who will get the most out of this. Pretty much if you have money with in any account with the buy and hold method, this is critical for you to understand. You're going to see that as we unfold. Obviously, this strategy is for investors, active traders, entrepreneurs, professionals, retirees. It doesn't matter. More or less, somebody who has capital and who's very busy and doesn't want to have to stare at the screens all the time, but they want to make sure their money is going to be preserved when chaos hits the markets and to potentially grow your account during that time. So more or less, anyone who really wants to spend more time with their family, anybody who loves to travel, if you want to spend more time with your grandkids or your own kids, this is what this strategy allows us to do, is go live life while we can reap some huge benefits out of this market versus watching the screens all day, panicking, watching the roller coaster ride. I mean, over the last couple of weeks, we've seen the stock market rally and sell off intraday wise. If you get sucked into those screens, it's a lot of emotions, a lot of stress for no reason. So we don't really need to be doing that in order to have very significant returns on our account. So if any of this is interesting to you, you're not happy with your own trading, or you've got buy and hold with your long-term, investment accounts with Fidelity, Schwab, or Fisher Investments, or any financial advisor in general, this could be the most important webinar, what I'm going to show you here, for probably the next 10 or 15 years. And it's going to drastically direct how your lifestyle is, your retirement will be going forward if these markets do what I think they are unfolding to do. So what we're going to learn today, I'm going to show you the silent account and retirement killer. This really caught me off guard. A lot of people don't realize what this is. They don't realize the power it has to ruin your future, more or less. We're also going to talk about the secret to massive account growth. We're going to talk about how to identify market stages and cycles and how to make money when stocks and bonds are falling. And then, of course, one of the most important parts is how to execute the strategy for consistent growth on autopilot. And execution is key. So real quick, a little bit about myself. Born and raised in Collingwood, Ontario, grew up in an entrepreneur family. My parents worked, had their own companies. I saw them work, 60, 70, 80-hour weeks. I used to help them run their businesses. I'm a hard worker. I've also been to the top. My parents were highly successful when I was younger, and they also took a turn for the worse and went bankrupt, and we went straight to the bottom. So I have gone through the cycle. I know what it's like to have absolutely nothing but the furniture and the clothes on your back and have the family start from scratch again. And that has been a big key role in figuring this strategy out, a strategy to make money without risking our life savings and putting a lot of our hard work at risk. So I was really fortunate because that happened when I was young, when I was in high school. I was able to put a strategy together. I got involved in the markets when I was 16 years old. I got into the markets, started to trade, got out into university or college, finished there, trading all through college, and I ended up making enough money by the time I was 28 to build my dream house on the water here. We've got a Hobie cat, we've got Sea-Doos. I bought the house next door for my kids someday to come visit us. This is me just looking out over the bay. So, the markets allowed me to take full advantage of the market decline, the sell-offs and the rallies. And if you can take advantage of both sides of these, you can amplify your returns extremely fast. And that's what I want to show you guys how to do. So I've got a family. I've got my wife, Kristen, Ben, Mirabelle, myself, my daughter Competes, our little dog, Leo. And we're 4 minutes from the ski club. We fish, we spearfish, we kiteboard, we surf, we do it all. It's a pretty good lifestyle. And I was able to reach this when I was 27 years old. And I've been doing this, I'm now 41, and I've just been trading and sharing everything I do since then. And it's been a blast. And that's what I want to show you today, is how to take advantage of the markets in a way that is very passive, and you still get huge returns with your account growth. Now, I'm the author of Technical Trading Mastery, 7 Steps to Win with Logic, and I'm a regular speaker and guest post on a lot of different financial websites. And more or less, I share this strategy that I'm showing you today with individuals, CEOs, advisors, investment clubs. We've got a couple billionaires that use this strategy in over 130 different countries. So what I'm showing you here works with pretty much anyone who has capital that they want to protect and grow it quickly. Now, one of the last things that really kind of solidified how I was going to trade was I got my pilot's license when I was 14 years old. This is the model plane that I flew, got my license on. And when I was young, when at that age getting the license, the pilot always said, the instructor, he's always like, you got to follow these checklists. Checklists are going to save your life. He says, if you start to skip checklists or you don't complete a checklist, you could more or less crash and die. And so that was planted in my head at a very young age. I remember doing my solo and going through my checklist like over and over again, make sure I didn't miss anything. And so I carried that forward into my trading. As I got into trading, first thing I did was I got to systemize this. I got to make a checklist. Find this type of stock, do this, do that, do that. And I've carried that forward from pretty much the first day I got hooked on the stock market in high school. And so systemizing and putting processes in place allows us to duplicate the process, repeat it, and refine things over time. So that is between the bankruptcy and the risk, losing everything, and then learning how to systemize things has allowed me to really take advantage of the markets to the full extreme. So let's talk about problem number 1. So we're going to cover 3 major problems, but problem number 1 is all about how drawdowns can delay or destroy your retirement. And this is the silent killer. People don't realize it, and hopefully most of you guys understand what it is, but a couple weeks ago, I had, through the entire week, every single person I spoke to on the phone had no idea what a drawdown was. And it blows my mind because they trade their own money, they've followed me for a long time, and they still didn't know what it was. And if you don't know what it is, you really don't know how much risk you have in your strategy, and we're going to cover that. But more or less, drawdowns will cause stress, and they do cause death. And we'll try and touch on that as well. This is a very extreme situation, but drawdowns are deadly. So let's take a look at the 2001 market top in the SP 500. More or less, a drawdown is simply when the price has pulled back from a high, and the amount that it pulls back is the drawdown level. You can just call it like the loss that you're at, or how much your account has come down. And from the peak to the lowest level would be considered the max drawdown level. Now, that is one type of drawdown. There's actually 2 types. The first is value loss, which is this here. The second is time delay or time loss. And this one is very, very powerful in terms of pushing and delaying your retirement. The average bear market is going to postpone your retirement about 7 years. It is very important to not hold through one of these and go through the emotional roller coaster, and then also delay your retirement. So as you can see here, somebody who didn't get out, rode the roller coaster, delayed their retirement for 12 years of earning anything. And during that time, you'd be paying an advisor, you'd be paying ETF fees. So you'd still probably be down 15 or 20%, even when the price got back to break even 12 years later. So this is huge. If you're more or less 50 plus, or even 45 plus, the last thing you want to do is go into a drawdown like this and push you further into your 65, 75 years of age to retire, all because of not moving out of the market when there is a clear sell signal. NASDAQ was even worse. It was a 15-year window, pulled back. It had a drawdown of 83%, and then it took 500% return just to get to break even. But again, you'd still be down 20+% by the time you got here because of investment fees of funds, advisors, and things like that. Now, using technical analysis, we're able to gauge from a trend standpoint and sentiment standpoint. We can gauge when there's a bull market, when there's a bear market phase, a bull market phase, and we're able to move around and understand when it's really good to be long equities, when it's good to be out of equities, or playing something that rises when the stock market falls. So just understanding these giant tides in the stock market is very critical. This is a good high-level view just to know where we're at in terms of the overall major trend, up or down. So let's take a look at a current example. And this one, it really is just from is of last year. And there's two lines on here. This thick line going up and to the right is the CGS strategy, which I'll talk about in a little bit. But this light thin blue line is the average 60-40 portfolio, which the average investor has some blend of stocks and bonds in their portfolio. And last year we saw the stock market pull back almost 25%, so a 25% drawdown. And at the time I did this about a week ago, you'd already wasted 15 months, delayed retirement by 15 months, and we're nowhere close to this bear market being over, I don't think. And so there's a lot going on here. And if you were to rotate and follow the trends of the market, you can continue to move into different assets where your account is constantly hitting a new high watermark, even when the market is going sideways, chopping around. And that was one of the most important things last year. I think 5 different months, we kept hitting an all-time new account high. Only a few trades last year because it was a very slow year, but I'll tell you, it is pretty incredible to watch your account grow while everyone else is panicking and freaking out and having to downgrade their future outlook. So the drawdowns, which are also known as the biggest losses, are really important to understand. If you take a look at this end column, it's comparing the different assets. So we've got the SP 500, which is in the middle. It had a pullback of about 50+%. The 60-40 portfolio during this window, this goes back to 2007, had about a 38% pullback. And this is what most investors have, is they have some blend of stocks and bonds, and that's what most people suffered, somewhere between those two. Now, if you use a strategy that follows the market and rotates out of assets as they stop going up, and then goes find another asset that's rising while the stock market's falling, we've got a dramatically smaller drawdown. And I've talked to a lot of advisors and they say the same thing. They say usually when an account starts to get down about 8%, that's when investors start to panic. So the fact that we can stay under that threshold of panic, well below what the other strategies are, is very important. And I don't think a lot of people realize this buy and hold strategy, the risks that you have if you are more or less 50 plus or in retirement. If you have the buy and hold strategy, to me, it is one of the most dangerous things you could do. You can lose a lot of money. You can, it's going to run into some other problems we'll touch on in a little bit. So let's touch on the secret to massive account growth. And this may sound really basic. Drawdowns and consistency may sound very basic, but they are the two most powerful things that you need to grasp and understand, because it's going to throw most trading strategies and services out the window because they have high risk and they're not consistent. So that is the key, is to filter out the noise and find something that is consistent. So starting with $100,000 account, this is over a 5-year window. Which one has the best returns? More or less, as you can see here, this ROI of 21%, 20, this middle column, pretty darn good. Obviously, it's an aggressive strategy. Those are big returns. With an aggressive strategy, you get the occasional big loss as well. And then you've got the kind of steady Eddie over here, boring, consistent, 8%, 8%, nothing very exciting. But the reality is both of these generate the exact same amount of money. One of them requires a ton of effort, a lot of risk, a lot of time, and a lot of stress, while the other one just pounds away and just grinds the market out and just takes low risk opportunities and avoids market corrections and takes advantage of bear markets going forward. So just being consistent, something boring, slow, and consistent can match that of a very aggressive strategy that has big gains, but the occasional big loss. Now, I did an article recently I shared on my blog, which if you want to, you go read about it. It's about two pilots. They both invested $1 million. John, he was the consistent investor trading a very slow, boring strategy. Then there's Mike, he was the active trader. And what's interesting here, this is the wealth math I was talking about before. Now they're both retired and they both withdraw $50,000 a year to supplement their retirement income. Now, Mike made 8% return and the conservative trader, John, made only 6%. So he made less returns, but in the end, after 10 years, John had more money than Mike did, earning a smaller return. And this is where the most damaging thing for retirees comes into play, and most people have never even heard of it, which is sequence of risk returns. And this is really important because when you withdraw money every year to live off of, it can have a huge, if you've got a volatile account, this very first year, your account went down 14% and then you withdrew $50,000, meaning you have a lot less shares now because you sold them at a discount. And when the stock market rallies back, you don't have as many shares for your account to grow back all the time. And so whenever you've got a down year and then you have to withdraw money, it's dramatically cutting you off from future growth. And so this is a huge difference. This is $371,000 more just being conservative and playing it safe versus trying to swing for the fences and be a superhero trader. So that is pretty incredible. Most people don't realize this problem, which is called the sequence of returns risk. And I go into detail in that article, but this is more important than most people expect. Most people think 8%, a bigger return is better in retirement. It's actually all about being consistent, and you can make less and still make more than the aggressive trader. So this should be an eye-opener going forward. Wealth math, this is retirement math, very different aspect from a young trader with a small account swinging for the fences. Very different strategies. You have to be used in your lifetime. All right, so let's go into some exciting charts. Let's go into the charts here, and I want to show you how to identify market stages. Let's pull this up here. So let's take a look at the market stages. There's 4 stages in the market. I use Stan Weinstein, his book. If you haven't read it, it's great. He talks about how there's 4 stages in the market. I've drawn on here, stage 1 is a basing stage. I've colored it red because it's considered kind of dead money. It's not really moving, not trending up or down, choppy all over the place. Stage 2 is the profitable trading zone. It's a bull market phase. Stage 3 is a high volatility, very dangerous time in the market. And then a stage 4 is a decline, a major bear market phase. Now, if you notice that stage 2 is green and stage 4 is green. And that's because they are strong trending markets. It doesn't matter if something is trending up or down, we can make money from it. So a high level to figure out what stage we're in, Stan uses the 150-day moving average, which is like this dotted line on the chart. And the general rule is if the moving average is sloping up and price is consistently above it, then we're in a stage 2. When price is breaking through the moving average and it starts to flatline or roll over, then we know we're probably in a stage 3. When both are sloping down, prices below it, we're in a stage 4. And then when price is chopping through it and is flatlining, we're most likely back into a stage 1. So that's kind of how we look at those in a nutshell. Then we want to look at how the market sentiment goes. And this brings us to where kind of we are right now. I believe we're in this stage 3 complacency phase right here. We had the blow off phase here at the end of 2020, early 2021, where everybody piled into growth stocks. The whole world seemed to pile in, and then they broke to the downside. And 2022 was a year of stocks going lower, and people think that the bear market was last year. They think it's over, and people are getting back into growth stocks right now. The reality is, I think we're getting close to this stage 4 decline where things are going to get really, really ugly. Getting into positions up here is red because it's the maximum risk. You're at the top of a market cycle, which is very dangerous. And if we take a look at the cycles here, there's 2 cycles for the stock market. The first blue one is the stock market cycle, and the yellow one is the economic cycle. Now, last year, we saw the energy sector do very well. And in the last several months, we saw the precious metal sector do very well. It was one of the leading sectors for a little while there. And these are the last 2 core sectors that kind of rally and outperform the stock market just before we go off the cliff and start to roll over and sell off. So that is definitely a warning sign we need to be very aware of. And the stock market typically tops before the economy, because investors can see companies' forecast numbers are dwindling, layoffs are coming, things are slowing down. So investors start to move out of the stock market, and that's why it starts to go down. And then when we get the quarterly reports, which it takes a couple quarterly reports for it to be considered a recession, and then the economy goes into a technical recession after that. So those are all the really important things to understand. And one thing that we need to be aware of is this stage 4, or this big panic anxiety kind of sell-off is, there was a study done between 2007 or 2008, 2009. There were 6,500 suicides directly related to the drop in equity prices. And this is the type of collapse, this stage 4 decline, that is going to do a lot of damage. That is very scary. The last time we had one of these was 2008, and the one before that was the 2001 market top after it sold off, and that one lasted a few years. So don't think COVID was a stage 4. It was far from what a stage 4 is. I think we're coming into another major financial reset, and it is going to be devastating and potentially push retirements and ruin people's lives huge going forward. So if we take a look at this overall curve here, we got the euphoric kind of stage where everyone piles in and then rolls over. Let's take a look at the ARK ETF here. And if we take a look at this and zoom out, we can see we've got the same scenario. We had the COVID crash. The market started to rally up. The Fed, the government started to pump out the money. Everybody piled into growth stocks. We saw growth stocks sectors rallying 500–600%. Stocks were rallying over 1,000%. Then we saw the crack to the downside. Then we got the complacency move. This is in growth stocks. They're the first to top out, and then it's been into a stage 4 decline ever since. And so this is the ARK ETF. This is the group that will top out well before the stock market. The stock market actually kept going up and topped out over here, and now the stock market is coming down and is kind of about this level. The stock market hasn't gone into the stage 4 decline yet. Different assets will top or bottom first, and so these are the groups of stocks that go first. And a lot of people are actually thinking the ARK ETF is a killer buy, but the reality is, even at $38 a share, I think it'll probably be in the teens by the end of this year once the stock market falls off the cliff and we have a financial reset. So got to be very cautious. A lot of people thinking the markets are close to starting a new bull market, but I think we are far from that. So the other thing we want to take a quick look at in terms of the overall cycles is we got this weekly chart of the SP 500 above. The tide is going up, and then the tide is going down. We've got these signals in the market here. We've got a buy signal, we've got a sell signal, we've got a buy signal where the stock market might get some traction and continue to push a little bit higher. But this lower chart down here is our CGS strategy. So once we know the overall major tide of the longer term trend, we can actively trade this market and take advantage, avoid the drawdowns, play the upsides as needed going forward. And to get a feel for the more recent price action over last year, you can see how we can clearly see with our trend analysis when we can take advantage of the sell-offs, the bounces, the sell-offs, and when to get in, when to get out, be very cautious here in the market. So that's kind of how we look at the market and the overview of, I think, where we're kind of headed next in the grand scheme of things. So let's go back to the slides here. Let's go to problem number 2, which is what to own during falling in stock bond prices. And the reality is, you know, most people just hold things. The reality is we just need to buy a different asset that is rising in value. And so I use this position hierarchy or an asset hierarchy of these 5 different asset classes, which is US stocks, treasury bonds, the dollar index, the inverse dollar index, and a cash position or bill. It's a treasury note. You just collect interest more or less every week or every month sitting in cash. And so the reality is when we look at this column here, this is telling us the volatility in a percentage basis over the past 20 days. The SP 500 from the highest high to the lowest low during the last 20 days was 14.28%. Lots of volatility. Bonds has just about half of the volatility of the stock market. And then the US dollar has got half of bonds, and then cash is very low volatility. So as the market gets crazier, we start to move down this list to slower, more conservative assets, and they have no correlation to each other. And we generally look for the one that is in a bullish phase, which the US dollar index last year was the biggest mover, the biggest gainer. It was an incredible way to pull money out of the market. So here's an example of what I'm trying to show you all in a nutshell, kind of layered in. This is the asset hierarchy. So we got SPY, TLT, the US dollar, the inverse dollar, and then a cash position. Now, naturally, we want to be long the stock market, which is green bars. When we get a red bar, we move down the hierarchy to look which one has the next buy signal. And I remember during the COVID crash, it was before the COVID really actually hit, we had the sell signal in the market. We got into TLT, and in 9 days, it blew past our 15% target and gapped higher, and we got out at 19%. On the day, the morning that bonds put in the high that we are far from now, and they've been out of favor ever since. Once we got out of that with our protective stop in place, we ended up moving to cash, collected interest, and then eventually, when the stock market stabilized, gave us a new buy signal based on technicals and sentiment and money flow, we got back in, and this continued to go up for about another 18% rally after that trade. The crazy part is we got out near top, we made a ton of money, collected a little bit of interest while the world was falling apart. We got to buy back in at almost a 13% discount. So this is huge. This is what, this is super efficient investing in trading. It's knowing when to rotate from one asset to a different asset and then to a different asset. It's not blending and holding a bunch of them all and letting them just kind of wish-wash each other and kind of all go down together during a bear market phase. So here's another one. We were in the stock market. Bonds were out of favor. We got into the US dollar. It rallied up. The stock market gave us another buy signal, moved over again, and then we got back into the dollar for another big move. Well, the stock market fell almost 14%. This type of scenario, this was 2022, the first half of 2022. This type of scenario, on a $100,000 account, it's about $9,000 return versus a almost $14,000 loss. Obviously, if you've got a larger account, $1 million, the difference is $140,000 loss or a $90,000 win. That is a huge spread between profits and losses, and a huge difference in your mental state, your outlook on life, everything going forward. So this is really important stuff. And so those are the two examples that you can get an idea of how we can walk around the market, when to be in one asset or the other. Now, the other big thing we want to focus on here is how to execute investing signals. And this is a lot more complex than I think people understand. Executing trades is a very emotional thing. I've been sharing my trades since 2001 is when I started sharing with my trading newsletter. And I still have the same thing. When we get a new trade in the market, for about a week after I issue a trade, I get emails, I get phone calls from people saying, I missed the trade. Oh, I didn't like the trade. I didn't get in, but now I want in, it's moving. Or, we go to take partial profits And, a couple of days later, I get the email saying, I didn't take partial profits. I liked it. It was still moving up. I didn't want to get out. Now what do I do? It's going down. Or we hit a stop level and we get out and we can sleep at night. But I get emails from people saying, I'm still holding it. I still believe in it. You like the trade. I mean, people have a great way of screwing up trades. And it's probably the #1 problem out of everything is just people getting in their way, that they just can't follow rules. They can't take a loss. They don't want to take partial profits because why do they want to sell a winner? It's the wrong mindset, and it's really, really important. So that is kind of one of the things that you need to understand. You need to have faith. You have to believe in a strategy and follow the checklist, follow the trades, work your way through those positions. And the nice thing is when you have a strategy, you can identify, what could happen next, usually a few days in advance. We know typically 2 or 3 days in advance if we could be getting into a trade, getting out of a trade, taking partial profits, and just being mentally prepared a couple days before and paying attention makes a huge difference going forward. So there's 2 ways that we can execute a strategy. I share with you the CGS strategy, which I trade with my own investment capital. I built the strategy for myself. I've been refining this since 2001, and that's where I trade the majority of my money because it's the best growth with the smallest losses or smallest drawdowns. And it allows you to trade unlimited capital because we just trade ETFs. So you can trade millions of dollars if you want to in a position, and you don't have to bat an eye. Nothing like trading stocks that move and push around in value. So there's 2 ways that you can follow the strategy that I'm going to show you here. That is simply just follow the trade alerts and execute it in your own account. I think most of us here are active traders, so this might be something you're interested in. The other way is just to have it auto traded in your self-directed account. And I offer auto trading at no additional cost because I truly believe if it's the best way for investors to have a portion of their money managed. If I can get the trader out of their account to stop messing it up, you just let the strategy run. It's an investing strategy. Time is money, and it's all about being consistent. It's not swinging for the fences, and you don't have to get emotional. And so those are the 2 ways that we can do these. It's done for you, or you have to, be self-disciplined enough to follow that. So, yeah, I mean, auto trading is pretty straightforward. It's very similar to the robo advisors like Wealthfront or Betterment, where the computer automatically, the broker automatically executes the trade. So you just say how much money you want managed in your account. The broker will automatically manage and execute those trades for you. So this is a picture of the equity curve of the CGS strategy. This top line is the CGS, which stands for consistent growth strategy. That is what pretty much we all want. In the end, the reality is we just want to consistently make money. And if you can do that consistently, you can dramatically outperform the stock market. We've got the SP 500, we got the 60-40 portfolios, which have huge risk and downtime. You can see here the max drawdown of the strategy is less than 6%. The average annual return is over 15%, and that is twice the type of return you get with the buy and hold, with a fraction of the risk and volatility at play. So for example, in the past 10 years, if you just compare the CGS strategy with $1 million invested, withdrawing $50,000 a year to help supplement your retirement, the average return over the past 10 years is about 16%. Your account goes from $1 million to $3 million, and that's withdrawing capital, versus the 60-40 buy and hold, which is what most people do with their largest account, which is just be very passive and do nothing. In the last 10 years, it's only generated about 5.78%. You'd really almost have the same amount of money you started with. Obviously, you've withdrawn $500,000, but you're not growing at all, versus something that is consistent that makes more than twice the returns of the buy and hold. Not only are you enjoying retirement, but you're getting wealthier every year. You've tripled your account over that 10-year period. So it is really important to have a consistent strategy that just grinds away versus swinging for the fences, being really active trading and trying to do all those things there. So that is something that I think is really important for people to understand. The CGS investment method provides both the consistency for the long-term gains. It generates high average annual returns, and really it just supercharges a retirement account. So, each year you could technically be spending a lot more. You could really live the lifestyle, travel, take friends and family on adventures and bucket list trips, and buy nice things for people. It's a very different lifestyle than just treading water and just putting your time in and knowing eventually you might eat through it. So a huge different scenario here. So the reality is you can suffer or you can succeed as a trader or an investor. As we all know, this world is really getting turned upside down. And I think the stock market is close to another 35% or more decline. And whether you believe it or not, it doesn't really matter. The key is you have to have a strategy in place that's going to protect you if this market collapses and goes into another financial reset. The super cycle reset that we're at is actually similar to the 2001 market top in terms of asset pricing, commodity pricing, the US dollar index pricing. Everything is coming back to the beginning of a major super cycle. That was a 12-year recovery for the stock market. That was a huge, huge drawdown. And it's not something that people are going to want to go through and push that retirement or your lifestyle, downgrade your lifestyle to a level that you're not really all that happy with, when you can sidestep all of this and actually kind of thrive. And the key thing here is what's really important is wealthy men and women generally have about 8 to 9 more years of disability-free life after the age of 50. Versus what poor people have. So there was a study done, this was done, the English American Adults Association, it was in the New York Times, they did a study, and more or less, and I can relate to this because I went away at Christmas on holidays, I hurt my back, I was out of commission for more or less a month, could barely do anything. And it really hit me. I can't imagine being, having a disability. If you can get an extra 8 or 9 years when we're older to be able to go do the activities and play with our kids and our grandkids and all that stuff, that is priceless. And the reason why wealthy people have 8 or 9 more years of disability-free life is because they have a better frame of mind. They don't have the financial stress, which means they travel. They go do fun activities. They're much more active into sports and different things. They do a lot more fun things with their friends. If you're a happy person and you're doing things you enjoy, your body stays a lot younger. And so it is really important to not be watching your account, your retirement underwater. And it's very stressful. It's hard on the body when you're always operating and living with the worry of money. It does a lot of damage to your health. And obviously, it kind of kills your wealth going forward. So more or less, that's the key thing here. So I'm just going to wrap up with the final offer here to show you what we've got. More or less, you get the consistent growth strategy, which is a Monday and Wednesday video report. You get the strategy, which we cover the markets. We can profit from bull markets. We can profit from stage 4 declines, big financial resets. All the signals are end of day, meaning once we have a closing price, we send out an alert in the afternoon, in the evening after the market has closed. And so you've got all night to take the alert and put in your order to do a market at open the following day to get into whichever ETFs we're getting into. And it's a pretty straightforward strategy. We give you everything you need to symbol, price to get in, protective stop, where our targets are, how much allocation for each target do we take out, and our position sizing. Also providing the auto trading, so you can just have it, set it up once and have it all done for you in your brokerage account, so you don't have to lift a finger. There's also, if you want to get right into it though, we got the 7-hour technical analysis video course, and then we do live mentoring sessions every month, 2 of them. We just had one Thursday night with subscribers, and we get on the charts and you just ask whatever you want. We cover all kinds of random topics, especially into real estate. People are definitely wondering what's going on with the real estate market. But we get to go through everything, and you can ask all the questions you want, which is very valuable going forward. The other thing you get here is the Band Trader Best Asset Now strategy, which if I just skip forward here, more or less we've got a hot list of the hottest sectors. We can know at any time which sectors has the money flow, which ones are primed and ready to pop. More or less when we get a band trigger, which are these green boxes on the bottom, during a bull market, this is when this strategy is super powerful. You get these explosive moves, 17, 8, 21, 11, 17, or 11. This is really powerful. If you're an options trader, when we get these, if you catch a 17 or even an 8% move in 4 or 5 days, you're talking huge returns. So those are the whole plan there. You kind of get everything you need to either be a passive investor and just grow your account and go live life, or you can be super active, get in there, trade the hot sectors, trade these signals on your own, and go from there. So if you go to thetechnicaltraders.com/exclusive, then you can go ahead there and subscribe for this offer. I should be able to put it here in the chat room. You can click on that if you want. Hopefully you guys learned a little bit of something, got something out of it. Remember, there's 2 different types of drawdowns. Both of them combined really do a lot of damage, and wealth creation changes a lot when you are in your later years. It's not about big returns, it's about consistency. And don't get consistency confused with a conservative strategy that doesn't make anything. We want something consistent that generates high returns still. That's where we get a lot of power. So Rob, that's the 45 minutes, and hopefully, I know it was a little rushed there, but I'll give it back to you, and hopefully everybody got a little something out of that, and make you look at the markets and investing a little differently.
No rush, no anything, but I want to say thank you, Chris. I thoroughly enjoyed